Have you ever felt that rush? That feeling when a stock you picked just keeps climbing, and you start dreaming of what you'll do with all the money. Maybe you start thinking, what if I just held on a little longer? What if I put in a little more? That, my friends, is the siren call of greed. And in the world of investing, it can be one of the most dangerous emotions you'll ever face. Today, we're diving deep into the psychology of investment greed, how it can derail even the smartest investors, and most importantly, how you can recognize it and keep it from controlling your financial decisions. Let's start with a story. Think about the dot-com bubble in the late 90s. People were quitting their jobs to become day traders. Stories were everywhere of regular folks making millions overnight by investing in any company with a Tom in its name. The markets seemed to only go up. The excitement was contagious. It felt like a can't-lose situation. This widespread feeling is a classic example of market euphoria, which is basically greed on a massive, collective scale. Investors weren't looking at company fundamentals like profits or business models. They were buying stocks simply because they were going up, driven by the fear of missing out or FOMO. They saw their neighbors getting rich and thought, I need to get in on that. Greed told them that this was a once-in-a-lifetime opportunity and that the old rules of investing no longer applied. But what happened next? The bubble burst. Valuations that were built on hype, not reality, came crashing down. Fortunes were wiped out almost as quickly as they were made. Those who let greed drive their decisions, who bought at the peak because they couldn't resist the allure of even more gains, were the ones who got hurt the most. This isn't just a history lesson. This pattern repeats itself over and over again in different markets and with different assets. Whether it's real estate bubbles, cryptocurrency frenzies, or meme stock manias, the underlying emotion is the same: greed. So what does greed actually do to our brains? When we see our investments skyrocket, our brain releases dopamine, the same chemical associated with pleasure and reward. It feels good, really good. We start to associate risk-taking with this pleasurable feeling. This can lead to what psychologists call a hot hand fallacy, the belief that because you had a few successful trades, you're on a winning streak and can't lose. You start to feel invincible. You might ignore your own well-thought-out investment strategy. You had a plan to sell a stock once it hit a certain price target, but now that it's there, greed whispers in your ear, why sell now? It's just going to go higher. So you hold on, and maybe you even buy more, increasing your risk exposure at what might be the worst possible time. Greed also makes us overconfident. We might start concentrating our portfolio into one or two high-flying stocks, abandoning the golden rule of diversification. Diversification is your best defense against unexpected market downturns. It's like not putting all your eggs in one basket. But when you're blinded by greed, you might think you've found the one magic basket that can't possibly drop. You convince yourself that you're a genius, that you've figured out the market in a way no one else has. Another dangerous side effect of greed is that it pushes us to take on too much leverage. You might start trading on margin, which is essentially borrowing money to invest. When things are going well, leverage magnifies your gains, and it feels incredible. But it's a double-edged sword. When the market turns against you, leverage magnifies your losses just as powerfully. A small dip in the market can lead to a margin call, forcing you to sell your positions at a loss to pay back the loan, which can wipe out your entire account. The story of the GameStop saga in early 2021 is a perfect modern example. A community of retail investors on Reddit managed to drive the stock price up by thousands of %. The stories of instant millionaires were intoxicating. People who had never invested before were suddenly pouring their life savings into this one stock, driven by a mix of greed and a desire to be part of a movement. For a lucky few who got in early and out at the right time, it was a life-changing event. But for many others who jumped in late, caught up in the hype and the fear of missing out, the outcome was devastating. They bought at the peak, just before the price collapsed, and suffered massive losses. Their decisions weren't based on an analysis of GameStop's business. They were based on pure emotion and the greedy desire for quick, astronomical returns. So, how do we protect ourselves from this powerful, destructive emotion? How can we be disciplined investors instead of gamblers? The first and most crucial step is to have a plan. Before you ever invest a single dollar, you need a clear, written investment plan. This plan should outline your financial goals, your time horizon, and your risk tolerance. What are you investing for? Retirement? A down payment on a house? How much risk are you comfortable taking to achieve those goals? Your plan should also include specific rules for buying and selling. For example, you might decide to sell a portion of a stock once it has doubled in value. Or you might set a stop-loss order to automatically sell a stock if it drops by a certain percentage. Say 15% to limit your potential losses. Having this plan written down is key. When you're in the heat of the moment, with the market going crazy and your emotions running high, this written plan is your anchor. It's the rational voice of your past self, reminding you of the strategy you created when you were calm and clear-headed. Sticking to your plan is the ultimate antidote to emotional investing. The second strategy is to automate your investments. Set up regular automatic contributions to your investment accounts, like a 401k or an IRA. This technique is called dollar cost averaging. By investing a fixed amount of money at regular intervals, regardless of what the market is doing, you take the emotion out of the equation. You buy more shares when prices are low and fewer shares when prices are high. It's a disciplined, systematic approach that prevents you from trying to time the market, which is a game that even most professionals can't win. Third, practice gratitude and contentment. This might sound a bit philosophical, but it's incredibly practical. When a stock does well, learn to be happy with a solid, reasonable gain. You don't have to squeeze every last drop of profit out of every single trade. Remember the old Wall Street saying, "Bulls make money, bears make money, but pigs get slaughtered." Don't be a pig. Celebrate your wins. Take some profits off the table according to your plan and rebalance your portfolio. Selling a winning stock and locking in a gain is never a bad decision. No one ever went broke taking a profit. Fourth, keep learning, but be skeptical. Stay informed about the markets, but be wary of hot tips and get-rich-quick schemes. If an investment promises guaranteed high returns with little to no risk, run in the other direction. There is no such thing as a free lunch in investing. The hype you see on social media or in news headlines is often designed to generate clicks and excitement, not to provide sound financial advice. Do your own research. Understand what you are investing in. If you can't explain the business or the asset to a 10-year-old, you probably shouldn't be putting your money into it. Finally, understand that losses are part of the game. Not every investment will be a winner, and that's okay. Even the greatest investors in history, like Warren Buffett, have made plenty of losing bets. The key is to manage your risk so that no single loss can wipe you out. Do I and let a loss trigger a desire for revenge, making increasingly risky bets to try and win your money back quickly? That's just another form of greed, and it almost always leads to even bigger losses. Accept the loss, learn from it, and stick to your long-term plan. Investing should be a marathon, not a sprint. It's about building wealth steadily and patiently over time. Greed tempts you to sprint. It promises a shortcut to the finish line, but more often than not, it leads you off a cliff. So, the next time you feel that intoxicating rush, that urge to throw your plan out the window and go eeling on a hot stock, take a deep breath. Step away from the screen. Reread your investment plan. Remind yourself of the dot-com bubble, of the GameStop frenzy, of all the times that greed has led investors astray. Choose discipline over dopamine. Choose strategy over speculation. By recognizing and managing the powerful emotion of greed, you can protect your portfolio, stay on course to meet your financial goals, and become a more successful and certainly more peaceful long-term investor. Thanks for watching today. If you found this helpful, please hit that like button and subscribe for more content on smart investing and personal finance. Let me know in the comments if you've ever had a battle with investment greed and how you handled it. See you in the next video.